Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. This video is going to be focusing on the SP 500. I'll be discussing the ASX 200 and gold in a separate video, and I'll leave a link to that in the description section below. I've also got a couple of fascinating graphs for you, so make sure you stick around for those. As always, it's general commentary and doesn't take your personal situation into account. All right, with that said, let's jump to our first chart. So we've got the SP 500 on the screen, and this really has been an incredibly interesting week. So you might remember last week I was talking about the possibility of the SP 500 rallying. So this was the point of last week's video, down around this just above 3,700, and my thoughts that the market could rally were based on a few factors, but one of the big ones was that the SP 500 wasn't reacting to bad news. And the bad news that we just recently had, which the market brushed off, was a big inflation number. Now, as you can see just through here on Wednesday and Thursday of the previous week, the market did try to sell off. But what was interesting was that when the market broke below this June low, it dipped below that June low, but it wasn't able to generate further selling. There wasn't follow-through selling, and the market then snapped back above that potential breakout point and started to rally. And when I see that sort of price action develop on a chart, what I really start to wonder is, has everyone who wants to sell, have they already have sold? And it's been really interesting over the last few days to see the S&P 500 put on several strong days in the rally we've seen over the last 5 or so days. And so I'm filming this after the US market closed on Friday. Now, what's been interesting with the most recent price action is we've been able to draw in this bullish flagging formation on the chart. And we can only do that now because we've had to wait for this key point here to get this lower trend line. And that developed last Friday. And so we've got this pattern, and now we've got a breakout from the pattern. And another thing that's happened is that the S&P 500 has closed above, so this is a 50-day moving average here. It's closed above the 50-day moving average for the first time since April. So you've got to go back over here to get the last close above the 50-day moving average. So it's been quite a stretch of weeks, or really months, of being below this 50-day moving average. So the question is, does this mean that a new bull trend is underway? Well, unfortunately, I think you have to say it's too early. It's just too early to say whether that's the case. The S&P 500 is still below the 100-day moving average, which is this top moving average which we have on the chart, and the two moving averages, they're both still trending lower. So that's why I say it's too early to start saying, well, look, is this a new uptrend? Because whilst those moving averages are declining, the primary trend remains down. So I think at this stage, I think the odds favour that the strength we've been seeing over the last few weeks. I think the odds favour that this is a bear market rally. But having said that, we always want to keep an open mind, and we want to assess new clues, and we want to assess new pieces of information as they come to light. Now, what I want to do, I want to show you a couple of graphs which act as pieces of this bigger puzzle we're trying to put together in terms of where the market's going. And they turned up on my Twitter feed through the week. Now, the first one it's this one here. This is the first one I want to talk about, and this is from the JP Morgan Equity Derivatives Strategy Team, and it involves call options on the VIX, or the volatility index. And what's interesting here is what this is doing. This is essentially showing us the number of options that are being used to bet on a crash. And as you can see, This is just really, it's just going off the chart. It goes back to 2015, and the increase in the number of options betting on a crash has just skyrocketed in the last really since the start of this year, and has continued over the last few months. And now the number I want to focus on here is this one here of 40. So this is the price on the VIX, which all these options start to kick in. Now, let me quickly jump over to a chart of the VIX, and I'll explain what this 40 means. It becomes a little bit clearer when you look at it on a chart. So I just need to scroll down and locate the VIX, and here it is here. So this is the volatility index. And over the course of this year, it's been in this big contracting range. You can see these green trend lines. It's been in this big contracting range. Now, this red line here is 40. That's where all those bearish options start to kick in. Now, here's the thing. The only way for the volatility index, or the VIX, to get from where we currently are now down here to around 24, the only way for it to get from here up to here is for a spike in volatility. You've got to get a really big upward spike in volatility for these options to really start to pay off, like we saw here during the COVID collapse. And the way you get a move like that is for the market to crash. And one of the things we know about markets is that if just about everyone is anticipating an event, it's probably not going to happen. So the fact that there's so much activity going on in these call options betting on a crash means that, to me, it means that it's much less likely that it's going to happen. And I've got another fascinating graph which turned up. And this is from the Bank of America Fund Managers Survey. So let's just focus on the top graph first. And this one involves risk taking. And it's the risk taking of these big global fund managers. What this is showing us is that risk taking is at its lowest level since over here in October 2008. So October 2008 was just after the steepest part of the GFC crash. It wasn't the final low, but most of the damage had already been done. And you can see where we are now. It's below those levels. The second graph, the one down here below, it's what this one is doing. It's showing fund managers' equity allocation versus cash. And again, you can see down here, we're down here at levels last seen during the depths of the GFC. We're even below what happened at the tail end of the COVID collapse. So some pretty extreme stuff going on in terms of how the market is positioning itself. Now, neither of these graphs, the call options on the VIX or these two here, none of them tell us that a final low's in. But what they do indicate is that a lot of selling pressure has already come out of the market. Now, another interesting development I want to show you is in the Russell 2000, which is the US small cap index. Just jump over to the Russell, and what we see with the Russell is that it's broken out of this bullish wedging formation. Just in the last few days, we've got this topside break from this wedge, which had been forming since back here in late January. And what's interesting here is that the Russell was one of the first markets to indicate trouble. So what we had for months in the Russell was this big trading range. Market had been trading within a big range. We got a breakout to the top side, which looked very encouraging. Looked like we're going to get a further rally. But then within a few weeks, that rally had failed and the market started to fall back in. That was last November. So that was a sign that all was not well in the market. So it was one of the first markets to give that indication. Now, is it one of the first markets to give us a give us a positive sign on the upside. So it's now breaking to the top side. We've got to be aware the moving averages still haven't turned higher, but the price action is at least encouraging. It is something to keep an eye on and see whether this bullish wedge formation does continue to lead to higher levels developing. So what does all this mean? What's this mean? So let's jump back to the S&P 500. And look, first of all, if you're getting value from this, please hit that like button. Please leave a short comment, even something like, hey, thanks for the video. It just tells YouTube that people are watching and people are engaging, and then YouTube shows other people, and it really helps me build my YouTube presence. So please do that. It helps enormously, because these videos, they're only short, but they take several hours to put together, to get the information, do the research, instruct it in a way that I can deliver it to you concisely and hopefully usefully. So please do that for me. And also, if you haven't, please hit that subscribe button. So you'll see my thumbnails pop up on your YouTube playlist and YouTube screen when you go there, and hopefully get some more useful information. So please do those things for me. It helps me enormously. Now back over to that S&P chart. Now, as I said earlier, I think the odds favour a bear market rally. But just looking at those previous graphs, there seems to be plenty of fuel to potentially push the S&P higher over the next few weeks. So how could you play this? Well, this is what I think. I think the cautious play is to wait for these moving averages to turn higher. So that approach is always going to get you in late. You never get in at the bottom when you're waiting for moving averages to turn higher. But what that also does, it helps you avoid bear market rallies, which happen so frequently during these periods. Like if you were letting the moving averages help you, you would have not bought in during this rally, and you wouldn't have bought in during this rally because the moving averages never crossed. So the moving averages can keep you out of trouble, which getting in early and getting involved in bear market rallies can both be financially and emotionally damaging. So there's a good reason to respect those averages. But a more adventurous approach is to consider some market ETFs. And I think these are probably a safer play than individual stocks at this stage, because the chances of an individual stock coming out with bad news and really being hit hard is probably greater than it is for the whole market to collapse in a single move. So let's jump over to an hourly chart. I want to just show you a couple of things on these hourly charts to help with all this. So ideally, what we want to see develop now from a positive standpoint would be to see the market just consolidate this breakout over the next few days, maybe the next week, and then start to punch higher and get it. Ideally we want to see a decisive break above this 4,000 level, which is still keeping the market in check. I'd like to see this market break above 4,000. I think if it can do that, I think that could be a catalyst for more buying to come in. What I'll be looking at on the downside is I'll be keeping a close eye on 3,800, which comes in around here. So 3,800 marks, that would break the low from Monday the 18th, and it would also bring the S&P 500 back below these previous peaks. And should that happen, then we start saying, well, look, this breakout, this could be a false breakout. And then after that, if the market then gets back below these lows here from a few weeks ago, so it's around 3,700. It's just below the bottom of this pattern. A break below 3,700, I think this has been a key level for several weeks, and a break there would put us back on alert for a new low. But I think the risk of a crash has receded. The fact that the markets couldn't sell off on bad news through this period here a week or so ago, I think that lowers the risk of a sharp decline over the next several weeks. And also the fact there are so many investors positioning for a crash, I think that also makes that risk of a big crash recede. But it doesn't discount the fact that the market could test lower, it could make a new low, it could shop around, and it could be difficult. So look, let's leave it there this week. There's been lots of interesting stuff going on. Hopefully that's been helpful. Hopefully that's giving you some ideas and some directions on how to play this market. Please give me a like. Please hit that subscribe button. Leave a comment. And I look forward to coming back, talking to you next week. Thanks for joining me. Bye for now.